All right, well, welcome everyone. Mercent is providing an ongoing session of subject matter expertise in the retail and e-commerce space, and I'm very pleased to welcome with me today Gian Fulgoni of comScore and Matt Nemer of Wells Fargo. And we're going to spend the next 20 minutes or so walking through some key market trends and data analysis 2013 year to date, and we'll be looking at some of the specific e-commerce trends that are top of mind for our retail customers this year, namely the rise of mobile and tablet devices, a move in the industry toward real-time dynamic pricing. We're going to touch on some news that came out yesterday, some speculation around Amazon's move into an expanded footprint for their grocery business and the implications on the industry for same-day shipping and so on. So, gentlemen, thank you for your time and willingness to come and participate today. I'm going to start first by just asking you to comment on overall industry trends, maybe provide some data and some insights into the big themes that I just touched on and that you're seeing in the market today. And just to start off with Mercent's own observed data, so Mercent publishes a quarterly index, an e-commerce performance index, and we track our portfolio of 525 major retail clients that are live and active on our platform. And we look at how channels like Amazon and Google are contributing to the overall growth of our e-commerce clients. And just to cite a couple of quick statistics, and then I'll turn it over to Gian. For our cumulative customer portfolio on all channels, we've really seen a pretty profound acceleration in e-commerce growth in the last few months. We've seen numbers in the 43% range for the month of May versus 20% a year ago for the same month. And when you look at the performance of our clients year to date in 2013, we're actually seeing 36% year-over-year growth, which is a pretty significant, it's a 10-point acceleration over 2012 at 26%. When we look at the individual channel contribution, it's interesting to note that we're seeing deceleration from Amazon, notably their third-party seller programs. And last year, Amazon's year-over-year growth metric on a same-seller basis was 35%. Today, it's coming in at 27%. So still significantly outperforming the organic e-commerce growth, but it is a downturn in terms of that year-over-year growth metric from Amazon. And Google, notably, as a function of that, is really outperforming Amazon in the e-commerce space. When we look at the growth of the Google Shopping program this year and last year, on a same-seller basis, Google product listing ads, part of the Google Shopping program, formerly known as Google Product Search, in spite of the shift from a free model to a pay-to-play model, Google posted 39% year-over-year growth for the second year running for our clients on the platform. So I'll hand it over to Gian at this point, and let's talk about what you guys are seeing at comScore year to date.
Okay, so I happen to have some slides with me.
Great.
Since I'm presenting tomorrow morning at 9 o'clock. But this is a retrospective view of the growth of e-commerce in total, broken into travel and then online e-commerce or retail. And so if you look at the right-hand side here, the most recent year, we had a 15% growth in retail, up to 186 billion. This excludes auctions. And then in the first quarter, a slight slowdown to a 13% growth rate. And it's interesting because if you ask people whether they were affected by the payroll tax and did that make them more price sensitive, did it cause them to cut back on shopping, the answer from about half of them is yes. So there's a little bit of softening there because of that. That seems to have been eliminated as we've gone further into the second quarter, and the growth rates have jumped back up to about 15 to 16% through the first half of the second quarter.
So you're seeing a recovery?
Yeah, a recovery from this slight, slight softening. But the other thing to bear in mind here is when we look at e-commerce is to compare it to what's going on in total consumer spending. And that's an interesting stat, because if you look at it on an apples-to-apples basis, exclude food, beverage, gas, which isn't really bought online yet, apples to apples, all consumer spending was only growing at 1%. Only 1%, while e-commerce retail was powering along at 13%. So the channel shift is continuing, and if anything, I think it's accelerating at this point. Eric, you mentioned the impact of mobile, and it's maybe one of the biggest technological dislocations that we have ever seen in any industry. We now have about 137 million people have a smartphone, growing still at a rapid clip. That's over 50% of all phones now are smartphones. You've got tablets are at about 67 million owners of tablets. In the fourth quarter of 2012, tablet shipments globally exceeded desktops for the first time ever. And it's really causing a change in not only how people buy, but maybe more importantly, how they access information.
And just on that note, on the prior slide, the blue line was tablet adoption and the white was mobile. So are you looking at a breakdown of the distinction between those two? Correct,
in terms of their usage and their usage for buying. Right.
Got it.
Right. Let me just show you this one other slide here, which is really staggering. So here we're looking at a 3-year period from February 2010 to February 2013. The total amount of time spent on the internet by device, and I'll build the slide up for you. So desktop time spent increased by 20%, which is great. But look at what happened here with smartphones. Smartphone time spent up almost 400%. It's approaching the amount of time spent on the desktop, and then you've got tablets on top of it. You put it all together, you got a doubling of time spent that's really being driven by mobile. That's how major the shift is that's being driven by these devices.
Great. Okay, thanks, Gian. So, Matt, you want to just touch on some of the trends that you're seeing from your vantage point at Wells Fargo? We can talk to data, or we can talk to just some of the overarching industry moves that you see occurring in the market.
Sure. Yeah, in terms of data, we use your data, and we use comScore data, so we love your data. I would say from the public retailer standpoint, the growth rates continue to be very strong. Amazon's been running up in the 35 to 40% range. We don't look at revenue growth, we look at gross profit dollar growth, because in revenue you have 1P and you have 3P and you're apples and oranges. In terms of the other large retailers, I met with Walmart last week. Their global e-com platform is running up around 30%. That's an acceleration in every market. In terms of some kind of smaller and mid-sized retailers, it runs the gamut, but I'd say the average for the public retailers that we watch is in the 30, 40, 50% range. Part of it is a function of how far behind they are. We have some folks that have just launched websites in the last year or two, and then you have others that have a very mature business that are probably tracking to a lower growth rate. Some of the other things that we're looking at right now in terms of the traditional retailers are enabling stores to be involved in the e-com platform, so turning stores into fulfillment centers. There's been a lot of new website launches and enhancements, mobile enhancements. Same-day delivery is something we just wrote a report about, and I think we'll touch on that a little bit later. So a lot going on for the public retailers that we track. Amazon still, is trucking along with a very high growth rate relative to most of the publics.
When we kind of sum all this up, it seems like maybe one way to describe it is we're seeing a real convergence in terms of offline retail and online commerce through the proliferation of smartphones and tablets. And when you combine that with sort of the changing role of these physical stores in the market, fulfillment through the stores, as you mentioned, obviously this has a big impact on retail. I want to come back to mobile numbers in a minute with you guys, but let's start with this news, or at least this speculation yesterday that came out about Amazon launching their grocery business. It seems to me that that's an interesting move by Amazon, maybe in the long term, more as a function of their ability to enable same-day delivery in metropolitan markets for a broader set of product than just grocery. But let's talk a little bit about that, and then we can talk about how mobile and tablet plays into that as well. So, Matt, do you have any thoughts on the Amazon announcement?
Yeah, so we were reporting about 2 months ago that Amazon has been buying very large refrigerators. These aren't, Sub-Zeros or GEs. These are really large rooms. They've been putting them in their distribution centers in California. We also know they're talking to farmers in the Hudson Valley in New York to try to enable a grocery business in New York. It's been reported they're going to launch 20 to 40 markets next year. But what it does is it drives frequency of visit. They can run that business at no profit or at a loss and attach general merchandise goods to those orders and really enable same-day delivery. It's very capital intensive. They need their own trucks, which they have in Seattle, obviously. And we'll see. They're launching LA this week, reportedly. It probably, from a Wall Street perspective, will be margin percentage dilutive. So these are low margin categories, but it will drive customer count and it will drive frequency. And I think it's something that all retailers, need to pay attention to, just in terms of taking that prime from 2-day to, say a 1 or 2 hour delivery window.
So it's interesting, if you look at the consumer packaged goods industry, it's probably been one of the industries that's least affected, at least to date, by the internet. Only about 1 to 1.5% of all grocery products are bought online, compared to 30% of consumer electronics. Now, one of the reasons could be that the supermarket operators are already running at low margins. The net after-tax margin, I believe, averages somewhere around 1%. So you don't have a lot of give, if you will, or ability to deliver groceries at home with all of the attendant costs. And I think that the Amazon move here is really pretty significant, because I suspect that what they've been doing is that as that state sales tax issue has come along and they've accepted it state by state, they then decide to build out these massive distribution centers state by state, close to the big urban areas. And I suspect that that's what they then leverage to deliver goods the same day. And I think if you're then going to go to groceries, you need some kind of a basic footprint or some other revenue sources that are helping cover the costs of that fleet of trucks and so forth that you need. And so they might well put the supermarket operators in a kind of a really defensive position here if consumers accept home delivery of groceries, because it really has, as I said, it hasn't happened here in the US, but if you look at other countries, if you go over to the UK, for example, yes, the store density is less there, mobility of the population is less, but they are running at somewhere around 10% of all grocery products being delivered directly to the home. So I think this Amazon move, just like the other moves that they've made, where they've affected so many other vertical industries, is going to be really important to keep an eye on.
I just want to add one thing. So Walmart is the largest grocer in the world, and they're the second largest provider of online home grocery delivery in the UK. They're watching this very closely. I met with them last week, and I wouldn't be surprised, they're already doing online grocery in California. I wouldn't be surprised to see them also make a very big push into home delivery of grocery. They generate $12 billion of free cash flow per year. Amazon is somewhere in the $2, $3, $4 billion range, so much more cash. They also have 4,000 points of distribution, which are their stores in the US. They're very good at distribution, and they have the brand recognition. And in terms of the food vendors, Walmart buys cheaper than anyone. They go to Colgate and Procter, and they pay a much lower price than Amazon does. So I wouldn't count them out, and I wouldn't be surprised to see some kind of a counter move from Walmart.
It's now, I think, about 12 years since Webvan imploded, which I always
was just going to go there.
I always think of when I think of groceries. But remember, they burnt through $1 billion, if I remember the numbers correctly. So it's going to be really interesting to see what happens here.
Yeah, so, not to focus too much on tactics, but when we look at this combination of the hyper growth in smartphones and tablets, when we look at the importance now of same-day delivery, obviously, Amazon is out in the market with their local metropolitan fulfillment centers enabling things like same-day grocery. it seems like Google and eBay are taking maybe a different tack. If Amazon is betting on the secular growth of e-commerce, in some ways the local mobile shopping focus of Google and eBay is sort of counter Amazon, if you will. For either of you, do you have thoughts on how non-Amazon retailers think about this, whether they're brick and mortar operators or e-commerce operators? What's important at this point, and where are the opportunities maybe to compete in the market?
Well, I think if you aren't paying close attention to mobile today and optimizing your site for mobile visitors, you're going to be in a world of hurt, because if I look at the same chart that I had up for the total internet, this is for all retail visitation, and you look at the impact of the phone, the tablet, and then again a doubling of time spent. The thing that's interesting here, though, is the way that these mobile devices are being used in the retail sector, and there are two things that are, maybe three things are important. One is showrooming, right? 40% of US consumers say they have performed that activity. 3/4 of them have done so, say the reason was to get a better price. And you've got the retailers now, the physical store retailers like Best Buy and Target, responding with price guarantees. Yeah, that might work, but its impact on margin is to be determined. The second way in which mobile is, I think, affecting e-commerce is you can buy off these devices. Our measurement is now showing that about 13% of e-commerce buying occurs on mobile devices, growing at 30% a year, which is more than double the overall growth rate of e-commerce. So that's something you got to pay attention to. And then the third aspect of this, I think, is the use of these devices to get information, or either the consumer pulling in information in support of a buying decision, or the retailer and the manufacturer pushing out information. And that's changing, I think, dramatically the way that advertising works in the United States. Total mobile advertising grew by 120% in 2012, according to the IAB. So you've got a dislocation here, the likes of which we might not have seen, maybe ever, that I think any retailer's got to pay close attention to.
I think the first step is product. If you're a retailer, and we tell our retailers, constantly be innovating, make sure that the product is, you want to be as exclusive as you can be. So it always, we can talk about the technology piece, but a lot of it comes down to merchandising. If your merchandising is unique or exclusive, and I mean real exclusives, not we have a different color than Walmart and Amazon have, but we've designed our own product. That's always the best defense. Beyond that, I think the basic fundamentals of e-commerce. Back to your point on delivery, Amazon is very good at getting products to you in 1 or 2 days via Prime, but their distribution centers aren't close enough to your house to where they can deliver in an hour. And I think they'll have that in Seattle, and they'll have it in LA, they'll have it in San Francisco. But there's a whole nother model emerging where companies are using courier networks to deliver in an hour. We wrote a report where we tested eBay Now, Google Express, and some privates, including Shuttle. And I think there's a whole neat opportunity around courier delivery, 1 hour or less delivery that Amazon really doesn't have a leg in right now. Currently it's free, so you should try it. But I think ultimately it could be $5 or $10 with the right volume, where you might not need to wait for Prime. And so that's another thing that retailers, I think, should be looking at.
It's Cosmo.com all over again. I know I have seen a few venture-backed companies that are focused on that last mile delivery space, and it'll be interesting to see who emerges in this kind of greenfield market, if it's not the major guys, or alongside the major guys. Just another topic we were going to touch on today is the dynamic pricing topic. Obviously, as tablets and smartphones have enabled consumers to have better information in many cases than the merchandising managers and marketers that are actually managing the line of business, that creates challenges for merchants to be able to strike the right balance between margin and sales volume, and between brand stewardship and competitive stature in the marketplace. Any thoughts on kind of the balance of power between the consumer and the merchant, and just observations on what you're seeing in the market with regard to the rate at which prices are changing, how consumers are reacting to that, and maybe how merchants should be focused.
So I started using the phrase about 3 years ago that pricing power is now in the hands of the consumer. And I think that all that these mobile devices have done is just make that even more of a reality. But dynamic pricing, I think, does give the retailer some ability to counteract that and not maybe have their prices be lowered for every transaction, but be able to do it maybe at opportune times so that they minimize the negative impact on their margins. It's tricky. But from everything I see, retailers seem to be aggressively supporting it, and the reports I'm getting back are encouraging.
Yeah, it'll be interesting to watch how it plays out sector by sector. You know, I think we're used to it in the airline business, and we'll have to get used to it in the retail business. But I think retailers will need to be careful how often they make changes. Of course, in the physical stores, that's not really possible. So you will widen the channel conflict that you have between online and offline, where your offline price will be fairly static, unless there's significant changes in signage that allow for that to be much more dynamic. And then your online price could be changing, 5 or 10 times during the day. So I think you have to do it because Amazon does it and everybody else is doing it. But I think you need to be cognizant of how often you're making changes and probably surveying your customers frequently to find out how much of a pressure point that's creating.
Yeah, I think the one interesting danger in dynamic pricing is that you could maybe inadvertently or deliberately sell a product to a higher price to somebody who's a regular shopper of yours, where the incentive is really being given to the new shopper, and that can be a problem. Because I think if your regular shoppers realize that that's the way that pricing is working, you're going to have some very, very unhappy customers on your hands.
I mean, that's the binary decision, right? Do I cannibalize my own margin from my own base in favor of competitive stature?
Right. Imagine if you're on a plane and you are a high mileage frequent flyer for American, and you just paid $500 to fly to New York, and you're sitting next to somebody, it's the first time they've ever flown on American, and they've been able to get that same ticket for $300. You're going to be a little bit upset about it.
Yeah, there's a loyalty versus acquisition challenge there. So I want to switch gears here and open it up for questions at this point. Maybe just a final thought on the Amazon grocery announcement. So, Matt, it stands to reason that if this is a low margin business for Amazon, margins will be compressed and their stock price is going to go way up, right?
That would be the logic behind Amazon shares, and it is. And they also, by the way, announced that they're going into India with they have a new platform that launched last night in India, B2C, which is probably a market where they're going to lose money, I would think, in the first few years, just given the fulfillment network is not well established, and so there are a lot of margin detrimental things coming down the pipe. But Wall Street doesn't seem to mind because they believe in the long-term vision, and they've stuck to their original plan since 1997. So they're getting a free pass right now.
I'm going to ask you guys one more, which is, what do you think the biggest changes are between the web van home grocer era of 12 years ago and either the technology or the scale of the businesses that are attempting to move into these markets again? Is this really just a Trojan horse, if you will, to get into that same-day delivery market?
Well, the biggest change, I think, is mobile, in that the couriers, the last mile, just there's so much more information flowing between your systems and the last mile. The couriers know, when to change route, best time, they can contact the end customer. Mobile really enables the business to be much more efficient, and instead of just being point to point, it might be that the courier is stopping at Bed Bath & Beyond to bring something to your house, but they're stopping at Radio Shack before Bed Bath to get to your neighbor's house, and then your neighbor has a return back to another store, and being able to commingle orders, I think on the courier front is part of what's driving better efficiency, and same for grocery. You know, it's mobile and all the enhancements that have been made to the trucks, and you know, best route and GPS. That's a big piece.
So I'd agree with that. I'd also cite two other factors that are different today from a dozen years ago when Webvan was around. One is that the consumer population of the United States is so much more savvy when it comes to e-commerce and buying on the internet. You've got a generational move since,
right.
Since that, and you've got so many people who I think would readily accept it. The second factor, I think, is that the logistics infrastructure is so much better for delivery today than it was 12 years ago. And just look at how big Amazon is and what they have as capabilities today that they didn't have a dozen years ago.
And FedEx too.
Yeah, well, FedEx too. But maybe underlying all of this, though, is I think a question as to whether consumers in the United States really want home delivery of groceries. I think that's still somewhat of an unknown, or how many of them want it, and how big the market is, and can it support the cost of doing it, because it's not cheap to do this. Remember, in the United States, the average consumer makes somewhere around 1.7 shopping trips to a grocery store per week. Yeah. So if you're going to offer home grocery delivery and you want a satisfied customer, you better be ready to go to that customer more than once a week, and that's not going to be cheap. But again, I think Amazon's maybe in the best position to handle this because they've got so many other revenue streams that are already coming from these homes that I think they can leverage off of.
Yeah, great. Thank you so much for your attention today. And just as a reminder, we're here at Mercent for the duration of the show. If you're interested in insights into leveraging Amazon as a partner, Google as a customer and order acquisition channel, or any other questions related to your e-commerce strategy, we're here and happy to help. Thanks again.